If you're going to watch any video on EVs in the next 6 months, make sure you watch this one in full. I cover the full state of the United States electric vehicle market, from the current crash in demand to what it means for Tesla and Tesla stock, and also what it means for legacy auto. And exactly how will we get out of it? I will cover these topics in order. First, what was supposed to happen, what really happened, why what was supposed to happen didn't, and how will we get out of it, and what will the industry look like. I spent several weeks researching this video, so I hope you get some insight out of it. Let's take a look at the stock movements first. Tesla stock, not good. Ford stock, not good either. Actually, look at the historical Ford numbers. This is the last 30 years. The last 30 years. 1998 still reigns supreme, I guess. GM stock, Here's what was supposed to happen. We were supposed to generally follow this S-curve, which determines the rise of EVs, eventually nearing 100% market share and the end of the Ice Age. This is how industry disruptions happen. At first slowly, then quickly. This is what happens with any disrupted technology. Look at the smartphone and the demise of the flip phones. You'll see the exact same curve. And things were going as expected, as you can see here. This is the beginning part of that S-curve I just showed you. But what really happened? The problems started poking their heads around the microchip shortages coming out of the pandemic. Car companies just couldn't produce enough cars. There was a significant imbalance between supply and demand, and this resulted in astounding new and used car prices as supply simply dropped off a cliff. The Model Y cost $60,000 in 2022. Remember when the Model 3 was announced to be $35,000? I do. EVs were just too expensive, both to produce as well as their sticker price. $60,000 for Model Y? Insane. Demand was huge. Shortages mounted. So companies started pouring money into fixing the supply chain and also manufacturing both ICE and EV vehicles. There were announcements left, right, and center. Here's just a couple. GM announces the Silverado EV, set for release end of 2024. I think it's a nice looking truck. GM announces the Equinox EV, set for release fall of 2023. I think they missed that one. Ford to triple production of the Mach-E to 200,000 units per year. GM even shoved out $1 billion for the new ICE engine. Let me repeat, a new V8 horribly inefficient ICE engine. As comical as it sounds, this kind of makes sense since ICE is where the money is for a legacy auto. Gotta keep the engine running until it disappears, right? So this all led to EV sales exploding in 2022 by 55%, with much more production slated for 2023 and beyond. Everybody basically became this. Drunken C-suites became drunk. There's much more from where this came from, but I'll leave it at that and continue on to section 3, why it all came crashing down. But before I continue, don't forget to like and subscribe. So, why what was supposed to happen didn't? The first problem is that of all the announcements that came in 2022 and before from Legacy Auto, not one of them had been thoroughly thought through. They forgot how to forecast and plan. The legacy CEOs became a bunch of jokers. See, when Tesla designs a new vehicle, they think of these things: when, where, how, and why. This is why they introduce new vehicles so infrequently. In fact, the last full new vehicle introduction from Tesla was the Cybertruck in 2019. That's going on 4 years. Sure, there's been revisions since then, but that's the last full new reveal, along with the Semi. both revealed at the same time. All the legacy companies were thinking was, let's just announce something. Anything. Just do a Photoshop render. And profit? Yeah, South Park jokes aside, that was as far as their thinking went. For example, all of GM's new vehicles were for their terrible OTM platform, which used already debunked pouch cells. Take a look at Sandy Monroe's videos about these monstrosities. It's hilariously bad. GM has since switched to 4680s, so they've corrected that piece of it. However, they're still manufacturing 2 new factories with pouch cells. GM, just pick one. CCS. Gotta love to hate it. Just look at this freaking monster. Another issue is everything non-Tesla was set to use CCS, which, due to Electrify America and others, had absolutely garbage charging stations that pale in comparison to what Tesla was making. Every one of these vehicles was junk because of CCS alone. They're soon going to switch to NACS, but it's going to take them a couple of years. So they're years behind the curve. Next came astronomical interest rates. 8%. Just look at that chart. It's crazy. The average American cannot afford $1,000 a month for their car payment. Me personally, I can afford it. I just choose not to. Even with Tesla slashing $15,000 per vehicle, a new car would still set you back over $900 per month. This is unsustainable and unaffordable for the average American. I mean, it's just not going to work. Long term, it just doesn't work. It gets to the early adopters, but the mainstream adopters, they need an affordable price for their vehicles. Now, we can scream to the top of our lungs about total cost of ownership until our faces turn blue, but the consumer does not know, and the consumer just does not care. I mean, we all know that EVs cost much less due to electricity versus gas. We all know that EVs have less parts and thus less need for maintenance. We all know that EVs have no oil, so no oil changes. We all know that EVs have a longer lifespan. We all know that EVs are far safer than ICE vehicles. All the consumers see is this. That's it. That's all they see. Why? It just doesn't make sense, right? So why? We've all been trained this way for literally 100 years, myself included. You go to dealership A, you see a sticker price. You go to dealership B, you see a sticker price. You start negotiating this huge lump sum sticker price, paying no mind to interest rates, fuel costs, repair fees, or anything else. This is the only negotiating point of contention. So, you now choose the car you want to buy based off of the sticker price that you negotiate. After you get the best top line sticker price that you can, it is at this point that the car you want is chosen. So you made your choice. You've chosen your car. TCOB, I was going to say a swear word, but this is YouTube, so I'll steer clear of that. You then go to the financing guy or gal who tries to sell you an extended warranty package. After all this nonsense, they run your credit and you get to know your monthly payment. You still do not know your total cost of ownership. Fuel costs? Don't know. Who knows? Repair fees? Who knows? And so on. It is not until a few months later that you'll be able to calculate your actual total cost of ownership. The other issue is the IRA $7,500 tax rebate that only takes effect when you file your next tax return. Next tax return. This means if you bought a car in January 2023, you would have to wait until you filed your 2023 taxes in 2024 to see the $7,500 rebate. you'd have to front that money for that entire span of time. And again, the average consumer, they just can't afford that. What's the problem with this? The problem is the customer has to front the $7,500 for an entire year, potentially. The point of sale price, whether at the dealership or online, did not show the price cut, or did not show the price including the tax credit. The tax credit thus was not helping car sales like it was supposed to. The law was broken, or I should say the implementation of it was broken. So given the items discussed above, the next should be obvious, right? Ford F-150 Lightning sales tank, down a whopping 45%. Rumors of a shift being cut, goal targets being cut. GM decided to discontinue their best-selling EV, the Bolt, and make some SUVs at that same plant instead, requiring retooling. What do they do after that announcement? They delayed those EVs. Okay, actually, let me get this straight. GM cancels the Bolt at the Orion plant in order to make Silverados instead. It then delays the Silverado one full year, while the Bolt will still be discontinuing production at the end of 2023. So there's going to be this gap where this factory is not doing anything. So what will happen at the Orion plant in the meantime? Your guess is as good as mine. GM then changes focus and says they will release a revised Bolt, but it'll be built in a different and unnamed factory at an unspecified time in the future. Got it? Okay, good, because I don't. GM scales back plans as buyers hesitate. This is where things get a little shaky. Ford pauses a $12 billion EV investment after saying electric vehicle sales are too expensive, obviously. The company has warned that electric vehicles are too expensive and that demand is slowing. Other automakers are also cutting investment and abandoning manufacturing targets. The problem that legacy automotive has that Tesla doesn't have is that legacy cannot afford to lower prices. Tesla has a profitable margin that they can work with. Legacy has a significant negative margin. So they just can't compete with Tesla on price. And Tesla, if they choose to, can price their vehicles to a point where the legacy auto manufacturers literally can never compete, just due to Tesla's cost advantage. However, due to the issues above, not even Tesla is immune. Elon Musk says that the Mexico Gigafactory will not be in full tilt until interest rates decline. Tesla has massively cut the prices of their vehicles, which some of their competitors are trying to match but cannot do so profitably, unlike Tesla. Tesla's price cuts make their profits smaller. Competitors' price cuts make their losses bigger. And finally, number 4. How will we get out of it, and what will the industry look like? Now here's some good information actually from Ford. They're showing clarity here, which I give them props for. Jim Farley's doing good in this stance where they're actually saying, hey, this is the way things are. And I give them serious props for that. Now, 36,000 units were sold by Ford last quarter. However, they incurred a $1.3 billion loss in their electric division. And I ran some numbers. That is a loss of $36,000 per vehicle sold. And that's not a repeat from the number I said before. They produce 36,000 vehicles, and they're also losing $36,000 per vehicle. And it's actually getting worse. Quarter-over-quarter gross margins declined substantially because they have had to cut prices. You can see here that their vehicles sold increased a bit, and the revenue actually stayed the same. Their EBIT cratered their EBIT margin cratered. So they're in trouble. They are in trouble. Legacy is in an unenviable position. They simply cannot afford to cut prices on their EVs. And economies of scale won't work for them since they are cutting production. The whole idea behind economies of scale is increase production and then the cost per unit decreases. But they can't leverage that if they're not increasing production. Legacy's auto strategy seems to be to slow things down and just pray and hope that the market corrects in their favor. Well, let's see how that works out for them. What about Tesla? Well, the easiest issue is actually being fixed automatically, not even by Tesla. Starting in 2024, the IRA tax credit can be shown deducted online right away, as well as at dealerships, since the tax rebate goes directly to the dealership, potentially, and not to the customer anymore. This directly reduces the top line price of the vehicle, and this actually will drive sales. This will help to fix the issue. A $50,000 Model Y suddenly becomes $42,500, and the customer will see this, and they won't have to front the $7,500 difference and wait a year. So it becomes $42,000 as long as you fall within the income limitations. So this one's in the bag. What else? The public in general has a massive misunderstanding about EVs. Most of them still have range anxiety. After all these years, range anxiety. It's insane, but it's true. They do not know about the superior charging infrastructure known as the NACS. They don't know the difference. They don't know or even care about the differences between NACS and CCS. To them, all chargers are the same. If they go to an Electrify America charger, that negative perception will carry over to all EVs they will consider in the future. So Electrify America is actually, in a sense, destroying the industry. Unfortunate. They need to either go out of business or fix their stupid chargers. The public does not know that EVs cost less to use and fuel, put that in quotes, than ICE cars. But they do know how much less it costs. Or I should say, they do not know how much less it costs. Only advertising can really fix this misunderstanding on how much the TCO is lower on an EV. The public does not know that EVs need less maintenance, and they completely forget that they don't need oil. Ironic, huh? The public thinks that batteries die early, and thus EVs die earlier than ICE vehicles. And yes, I've actually heard my mom say this literal line. I had to correct her on it, and there's many people like her. And so they need to be educated on how this incorrect idea came to be. That the battery, the fact is the battery will last longer than the other components in the car. And only really only advertising and word of mouth will be able to fix this little piece of it. It's a learning experience. And also the cost of EVs must come down. This will be done through economies of scale. Basically, as I mentioned before, the more you make, the cheaper the per unit costs, as the fixed costs, like, say, creating a factory, get spread to more vehicles. As a little bit of an aside, the UAW is not helping here at all. The UAW contractor will cost Ford $850 to $900 per vehicle. This means that if you were to purchase a Ford vehicle, any Ford vehicle, you'll pay nearly $1,000 more for the exact same vehicle you did last year. This is unsustainable. The other legacy automakers currently under strike will likely see similar deals and see similar cost increases in their vehicles. Tesla will be immune to these because, of course, no union. Tesla must do whatever it takes to never get under the UAW's umbrella. the UAW would be the death of Tesla, just like it's doing to Legacy right now. See, the thing is, unions do not represent the workers living better lives. The unions represent the workers collecting unemployment. Just think about that for a second. Now, I used to think that one of the big three will make it. I no longer hold that conviction. I now believe that one of them will fail at some point within the next 10 years, with the others to follow shortly thereafter. They will be replaced by better run companies, like Tesla, and perhaps some other startup, or a Chinese manufacturer. Also, interest rates, they must go lower. 8% is unsustainable. It jumped too far, too fast, too quick. Tesla said in their last earnings, we continue to believe that an industry leader needs to be a cost leader. I believe in that completely. Tesla benefits from a profitable energy business as well as services and other. Tesla's EV business is also profitable even in these shaky times. The important point is Tesla continues to be cash flow positive. No other United States EV maker can say this. They're all significantly underwater and getting worse, frankly. Their finances are just hilarious, just terrible. Just terrible. Also, the Cybertruck is ramping. Berlin and Austin are ramping. However, the Cybertruck won't be free cash flow positive until late 2024. Tesla, though, in the meantime, is paying very close attention to costs. On Tesla's earnings call, they mentioned that they have three main objectives. First is the cost reduction of their products. Second is investments in AI and other growth projects like Optimus. And third is continued free cash flow generation. Notice that Tesla will continue their research projects while still being cash flow positive. Their aim is to basically never have a negative cash flow quarter. They can adjust the prices as long as they remain cash flow positive. However, this does limit how much further they can cut prices because they're, as an FCF parameter, they're basically as low as they can be. They're at about 800 million right now in the last quarter. So they've cut prices about as much as they can, and they've actually increased prices on some models recently. So they do need to cut costs of their cars as much as they can. So price reductions will go hand in hand with cost reductions if needed. In the future, Tesla will continue to focus on costs and their new cheaper Model 2 vehicles and other vehicles coming down the line. I hope and expect them to begin advertising so that they can showcase the benefits of their cars over literally every other car in the market. Shamo says, don't forget to smash that like button and subscribe. Thank you for watching, and I'll see you in the next one.